This chapter will introduce you to money, what it is, what's required of it, the money supply, the purpose of the Federal Reserve, and different kinds of financial institutions including banks, non-banks, and savings and loans. Money, as this slide tells us, is anything that people will accept for payment for goods and services, and that might be a US dollar, it might be a Bitcoin. Back in ancient times, it were huge rocks or seashells. Barter, on the other hand, is the direct changing of goods and services. So I'll paint your house, and in return, I'll expect you to repair my car. One of the tasks of the Federal Reserve is to regulate the money supply, and there are three different measures of the money supply: M1, M2, and M3. And take a look at the slide, and you can kind of see the difference. M1 is just the money that can be accessed immediately. M2 also includes things like mutual funds and savings accounts, and M3 would include also big deposits like institutional money market funds. One of the reasons that the Federal Reserve manages the money is too much money out there would cause inflation, and too little money out there would cause deflation or a recession. And the three basic tools that the Fed uses are the reserve requirement, and that's the percentage of money, of deposited money that banks must have on hand. The open market, as they buy and sell treasury bills, government securities, and the discount rate, which is the rate that they charge banks for money that they borrow from the Fed. As you study this chapter, you'll learn that there are different kinds of financial institutions, and the oldest and most venerable out there is the commercial bank. And the commercial bank is a bank that takes deposits from individuals and corporations and loans that money out. Another financial institution type is a saving and loan institution, and a savings and loan institution takes deposits and for both checking and savings accounts, but their primary purpose is to promote home ownership by making mortgages. Credit unions have become very, very popular. They're nonprofit and they're owned by the members, and because they're nonprofit, they don't have to pay income taxes, and as a result, sometimes you can save a little bit of money on your interest rates when you borrow money, and also they pay sometimes a little bit more on their savings deposits. Another type of financial institution are called non-banks. They don't accept deposits, but they do in many cases make loans. And some examples would be life insurance companies or other insurance companies that are suddenly in the business of making loans. Because banks and savings and loans and even credit unions do fail from time to time, individuals will wonder, if I put money in this bank and it goes bankrupt, what's going to happen to my deposit? Well, for banks, they are insured by the Federal Deposit Insurance Corporation, FDIC, and each individual deposit is guaranteed up to $250,000. The National Credit Union Association also guarantees $250,000 per individual depositor for institution. So if you have more than $250,000 and you want to make it insured, make sure you put it into different banks. Well, as with most of these, this is just a brief introduction. A lot more about banking and financial institutions. You want to pay particular attention to the International Monetary Fund and World Bank as you're studying this chapter as well.